I will trust you and I will work with you and I will back you, but fuck me once and we're done. Of all the term sheet that we put down, we've won 91% of them. So people once asked me what I was looking for, a smart-ass team building a kick-ass product in a big-ass market. Those are the three S's.
Was 2005 Jeff able to do that?
2005, Jeff was a dumb fuck who knew nothing. I've been working my ass off for 21 years, nights, weekends. I also want to get a bit more sort of me time. If I was starting today, I would really focus my energy on, okay, this is the one thing I do, and I'm gonna try and get the best opportunities in that sector and then grow from there.
How did you get the @Jeff handle on Twitter? How come I can't get at Michael? Has anyone tried to buy it from you?
Oh, fuck that.
Welcome back to another episode of Invested. My guest today is Jeff Clavier. He is known as one of the best seed investors on the planet. And so thank you, Jeff, for joining us today.
It's a pleasure to be with you, Michael. It's been too long I've seen you, so thank you for the opportunity.
Yeah, just before we came on, I was mentioning, I think the last time we saw each other was probably 6 or 7 years ago in a cafe in Palo Alto. And the world has changed a bunch since then. Is that fair?
That was definitely pre-pandemic. So I think you're even kind by saying 6, 7 years ago. I think it's longer than that.
Oh, wow. Well, maybe I should ask you, given that, has anything changed in the world of seed investing since I saw you face to face last?
Oh, we probably have added, another 1,000 or 1,500 seed funds since we saw each other, since, there were none 21 years ago when I started SoftTech, Uncork. Raised one of the first seed funds in history, or $15 million fund too, in 2007. Then 2-3 years later, there were maybe 10, 20 seed funds. A few years later, there were 50. And then suddenly, because we demonstrated to the world that seed was actually an entry point for a lot of new managers, things just got out of hand. And now we have about 2,000 seed funds. So somewhere along that curve, we've seen, sort of a lot of capital flowing in the hands of people who are, good, but maybe not VC lifers like you and I, right? Where for us, there's not anywhere to go. We're sort of VCs and that's it, right? No one will ever hire us to do anything else. Whereas people now think about VC as kind of a step in a career, and they get in and then they get out. And there's been a lot of fluctuations in the VC world where people sort of join firms and then ping pong go around and then exit and whatever. So it's been kind of interesting to see. And in this world where it's really hard for companies to raise a Series A or Series B unless they have that crazy traction with numbers, going 5x or 10x a year and so on and so forth, we'll see the metal that those VCs are made of in order to help their companies.
By the way, you just made my life a lot easier on this podcast because you really teed it up exactly where I wanted to go. So when we when we both got started, like, there were seed investors. It was Andy Besselheim, who, from Sun, or some of the angels who invested in Google. And every once in a while, you saw Larry Ellison do a seed round. There wasn't an institutional seed environment. You were one of the first. I think it's 17, 18 years at this point.
Yep.
You institutionalized it. And now it feels like everybody's got a seed fund. To your point, there's like 2,000 of them. And so I want to ask you 3 questions at the same time. Number one, is this actually a category, or is a lot of this tourism? That's number one, which is kind of what you referred to about people kind of coming and going. But I want to say if these people are serious investors, they just want to have a cocktail party discussion. That's kind of point one. Point two is you're the granddaddy of the seed business. No, nothing about your age, just you've been at it longer than anyone. How do you keep differentiating yourself differently today than you did 15 years ago? And then the third question is, has the geographic scope of what you do or need to do changed because of that?
Those are great questions. So I will answer the third first. Geographically, we're still very much doing US and North America with a few investments in Israel, because obviously Israel is an incredible, source of innovation and entrepreneurs. Um, in the early days, we were very much Silicon Valley, New York, and Boston. Now we don't care where the CEO and go-to-market is in the US, Canada, um, but we really want the focus to be on the US market from a go-to-market perspective. And then engineering can be anywhere. It can be back in Israel, it could be in Europe, could be anywhere. It really doesn't matter. Because the pandemic has taught us that you can really sort of be innovating anywhere on the planet. And for us, what matters is this focus on the US market for sales and marketing. To your point about tourism, I do think that a lot of people who enter the seed market have a genuine interest in building something that will, last. The problem is that sometimes they don't know how hard it is, right? Because if, like, I was a VC when I moved, I became a VC when I moved to the US 25 years ago. I did 4 years as a traditional VC before starting SoftTech and Uncork. And that gave me an appreciation of what that means to actually be a VC, right? To actually manage a firm is a thing, right? And a lot of people just make the transition from angels or operators to VC without that prior understanding. And sometimes it's a hard landing when they figure out what that actually means. So I don't know that there is a lot of tourists. There certainly were a lot of tourists in 2020, 2021, when literally you just did that and you raised, a $50 million fund. Now, raising capital is harder than I've seen in maybe a couple of decades, right? LPs are extremely demanding. They only, back GPs that they think can really differentiate and not only generate, awesome returns, but also help them with liquidity. So the tourist aspect, I think, is sort of behind us, but you definitely hear people saying, look, I did this thing, I raised this fund in 2021, and it's hard, and so I don't want to raise another fund, so here is the fund, I don't want it, I'm just moving on. And LPs are like, well, yeah, you can't, especially as they back some solo GPs, there's nowhere to go, right? It's like, who do you give sort of anything portfolio to? So that's a real sort of concern. On the differentiation, I think that the big thing that we have, we're 21 years old, so we're an adult firm. So I've built an incredible sort of team that is able to really help entrepreneurs go from 0 to 1, 1 to 10, and 10 to 100, and then, sort of bring in great co-investors along for the ride. And we're always, or pretty much always, leading or co-leading the rounds that we get involved in. We write the largest check. We always buy 10, 12, 15% of the companies when we invest in a seed round. And so the number of leads in the market, firms that actually do what we do, that sit on the boards, that do all the work, is actually, something that you can count on 2 hands, maybe, 4 hands, right? So between 20 and 20. And over the last, couple of years, I think our win rate is 91%. So of all the term sheets that we put down, we've won 91% of them. So the differentiation is both the brand, the reputation, the fact that we really take good care of our founders. We've built this amazing sort of team on the platform side, on sort of talent that support our founders, and our founders just preach about everything that we do for them, and they help us win more deals, and they help us, through referrals. So that's how we do it.
Given what you said right now, I find in the seed stage that there's a lot of people who want to just join the round, to the point you made, right? There are very few leaders, people, and there's angels and seed funds, and everyone wants a piece of the round. But given what you said now, is it worthwhile collaborating, or you should just take the whole thing yourself?
No, we fundamentally believe, like, I've always believed in the virtue of collaboration. and bringing, other smart investors to the party. So a typical Uncork round will be, so Uncork takes, call it 50-60% of the round. Then there's very often a smaller seed or pre-seed fund coming in. We always leave room for great angels, people who have, small checks, but can really be instrumental in supporting the company. And then we always make room for insiders if they want to do that pro rata. So we, yes, we could take 20% of the round, but then, if you edge people out, they don't sort of come back and give you access to their deals. So you have to be like super thoughtful about that. And sometimes even, cutting back, and we've done it. Sometimes we collaborate with our, dear friends in the market, and we just take 10%, right? So you have to be really mindful of not imposing too much dilution, have enough ownership for your own sort of needs, but also make room for other people.
A lot of art, not science. I'm curious about something you actually said about 5 minutes ago, which is that it's a hard time to raise capital right now.
Yes.
I'll be honest with you, my experience is the opposite. That at least in the seed stage,
you're that good, Michael.
No. In the seed stage, everything's getting funded, and even quickly again. It feels like a little bit back to COVID, and so and we're seeing things get done quickly. Well, why did you say it's a hard time to raise capital in the seed
So
stage?
it's a hard time to raise capital for GPs.
Oh, for
right?
GPs.
So
okay,
like on the GP side, it's really like a lot of programs are coming back, as I'm sure you read the news, like a lot of endowments are under attack. So they're not really sort of that interested to put money to work. And so GPs have a hard time raising capital. On the other side, it's true that like the dollar amounts that are being invested are sort of up into the right. The number of deals are actually going down, which means that there's a super heavy concentration of dollars in the top, sort of companies, and they're all AI companies. Like, I don't have Q3 numbers because we're just wrapping it up, but at the end of Q2, like 40% of all the dollars in the US, invested in the US, went to 10 companies. Just think about it, right? And so, like, it's crazy. And certainly for anything which is AI with AI something, right? Either tooling or vertical applications with like good founders or whatever, they certainly have a lot of choices as to where they get funded, and things go fast. But it feels to me that we're just depleting funds very, very quickly when I hear about like, the mega funds investing $1 billion here or $2 billion there, whatever. Like at some point they're gonna run out of, their commitments. And founders have understood that SPVs are not that great. So if you can't do SPVs and your funds are running out, you need to raise again. But then if the LPs say, hey, I want liquidity, so I'm not gonna give you sort of more capital, we're gonna have an issue. I mean, we just raised a brand new, fresh 300 million just a few months ago. So we're good for 3 years. But I know, and we raised in record time. We were done in 10 weeks.
Because you're you.
I mean, it's hard. Like it requires meticulous preparation and work. But yes, the execution was very fast, and we appreciate all our LPs. So the point is, you have to pace yourself. And the one thing that you and I know very well, that LPs want you to tell them what you're going to do, and you have to do exactly what you said you would do, right? That's what they want. And so if you say, I'm going to deploy this capital over 3 years, and you show up after 15 months saying, oh yeah, I'm done, get me more, they will hate you. They may actually still give you another fund, but they will hate you.
By the way, you teed up another topic that I wasn't planning on covering, but I want to cover it now. Which is your allusion to the fact that perhaps private money is more finite. So there was an incredible chart by Michael Zimbalist, who is the chief economist, I believe, or chief equity economist at JP Morgan. And hopefully they can put it in the show notes, where he basically says the reason that the U.S. stock market keeps going up is because there's less and less equity available and more funds available. So you've got all this kind of liquid money out there from retirement plans and other things that's got to go into an ever decreasing pool of equities. And so it feels like the money for the public markets is infinite almost. The money for the private markets, like I said, because they have to actually go through a cycle of raising for LPs. You don't have like these automated things until the U.S. government changes its laws and lets you make kind of automated contributions to private money, which may or may not happen soon. It's making its way, I think, now through Washington. You've got like this imbalance where nobody's going public unless you can get like 400 million. You've got to privately finance all these companies till they get the $400 million of revenues from a finite pool of capital. And so you end up with this, not only a massive concentration like the Mag 7, you have massive concentration in the private markets as well, and a drying up pool of capital. Where does this take us if the U.S. government doesn't change the regulation around kind of automated contributions to private capital?
Well, I mean, that gets us to kind of a starvation of, so the mega funds have also, and I would add to what you said, that the mega funds have just increased their hold on the market, where they have an ability to raise multi-million-dollar, sort of funds every few years. And so a lot of the capital sort of goes there. And at some point, it creates a situation where, like, VCs who are not established, who haven't proven themselves, and proving yourself is really like fund 1, fund 2, it's all like on paper, right? But fund 3, fund 4, it's like, okay, well, show me the money, right? Like, show me DPI. And in an environment where, like, when you and I met and I got going, right? My time to return back in, 04, 05, 06, during like the early days of Web 2.0 was barely 3 to 5 years. Right? So that means that I was actually getting liquid like within 3 to 5 years. And when I raised Fund 2 in 2007, my angel portfolio was already 5x DPI, right? In 3 years, which you would never dream of that right now. It's just impossible given what the market is going. And then when I had my first IPO, Fitbit, in 2008, it was after 8 years, right? Now, you can barely hope to go public before year 13, 14, 15. Right? So the time to returns has doubled, and the time to prove yourself, just think about it, 15 years, it's 5 fund cycles. It's crazy, right? And so what's happening is you have real pressure on GPs to monetize early through secondary liquidity, which the good news, it's available. The bad news is the discounts, the spreads are just massive, right? And so people are only interested in your best names, as always, and they want to buy your best names at like massive discounts. And so you're basically trading your future returns to get a bit of DPI, which is really what LPs are trying to get you to do. So we didn't have to do that for a raise, but we know that there is definitely expectation to just actually show the money for real, because they need that to actually get the cash recycled and invest in new funds. And we're just, as you said, we're just stuck in the situation where there's a few IPOs, but like they're so high in terms of hurdles that they're hard to get. And M&A is kind of waking up, but it's in this kind of weird, especially given the environment from a regulatory standpoint, right, where you can't really sort of buy companies, so you kind of invest in them and you suck them dry of their talent or whatever. So it's super bizarre, right? But it's happening for just a happy few, and there is just like trillions of dollars of liquidity stuck in the system, because we just need more IPOs and more exits.
So I want to combine two things you said and ask questions. So it's taking 15 years, plus it's getting harder for GPs to prove themselves because it takes so long. So you have fund 1, fund 2, you don't have liquidity, you kind of or sub-optimize liquidity through secondary, and you can't prove yourself. And so, like, if you play this movie forward, is this bad for innovation? Meaning it's going to be harder for people to fund kind of breakthrough innovation in the early stages because you can't get really new funds running with capable people who can do this?
I don't think so. I think we're gonna get, and to be very candid, you and I could have had that conversation, Michael, like 5 years ago, and I would have said kind of the same thing. The scale would have been maybe a bit lower, right? But like people always, like true entrepreneurs will find a way to sort of get financed. It may take them 2 years to raise their first fund, but they will, have at it, and they will kind of prove themselves, and, maybe like hustle to raise another fund or whatever. So I don't like, I've been expecting a contraction of the industry, and to be very candid, it hasn't happened. Because if you ask me, the last time it made sense to have, like the number of funds that we had was probably back in 2010, when there was like 25 of us. Because it was really good. And we were working together because no one had big funds, and so it was super collegial, and it was awesome. It was a true community of people backing entrepreneurs. And then everybody raised, big funds, and started to not really compete, but like, we can't see like 3 or 4 great funds working together anymore. It's just impossible.
Yeah.
It's, the rounds are too small, and the funds are too large.
The big
So-
ones suck up whatever supply is available.
Yep. So I think, to your point of innovation, I think that seed is still very much able to support innovation. So pre-seed and seed. The big question for me, where really we have like a choke point, is Series A and Series B. Because what's happening is, like, everyone is trying to find a very, very specific type of company, which is, reinventing a sector, or AI enabling, certain functionality, or tooling some things. And then they will sort of try and plop as much money as they can. And as soon as one of those does a Series A, you can almost be certain that within 3 to 6 months, they're going to do another Series B. If it's not like 3 to 6 days, it's crazy right now. And so you just have this concentration of dollars in like very few companies. But if you have like a normal company which is growing nicely but not crazy, it's super, super hard to raise. And that's where I see, like, we're going to support these companies, we're going to give them a second seed or whatever, and we'll try to get them to break even. But like, breaking even early is like super hard, and you never get sort of to great sort of growth curve. And so you end up with something which is like barely interesting. So it's really challenging, and we're trying to guide our companies through this, and it's really rough. So to me, that's that. If you ask me what am I sort of really concerned about for my companies, is their ability to raise a Series A and Series B.
You're originally from Europe. I now live in Israel. The U.S. stock market has raised the standards such that the banks only take you public if you got, $300-400 million of revenue. Why hasn't something like the AIM in the UK, the Nouveau Marché in France, the Tel Aviv Stock Exchange emerged as an alternative to be a kind of lower scale IPO, meaning go IPO here when you got $80-100 million, and then you can kind of dual list on NASDAQ or the New York Stock Exchange? It feels like one of those should emerge to compete.
That's a great question, and we've certainly sort of asked ourselves that question with our companies which are doing well and are in the $100 to $200 million in revenue, but can't go anywhere because, as you said, like 300 million. I don't see company, except on the crypto side. Like, most of what's gone public recently, it's more like in the 400 to 500, right? And so there should be an ability to do what you just said. I think that there's a lack of appetite and aggressiveness from those other trading places like Le Nouveau Marché, or AIM, or like, I think the Australian Stock Exchange is actually the one that has actually listed a few companies. Like Life 360 went public there, and the problem is that from an investor standpoint today, if you do that, it's felt like a failure as opposed to a success. And then they flipped everyone and went public on NASDAQ a couple of years later, which is incredible, right? It's a great company which I passed on years and years ago. I was probably the first pitch of the CEO, and I remember it's the first time and last time I saw the entire team wanting to literally murder the CEO because his speech was so bad. But Chris has done amazing afterwards. But it's funny, it's still stuck in my head. And so there should be this sort of on ramp to that sort of goes, you go public there and then you go there. But I think that the other markets is just not aggressive enough, and local investors are kind of afraid that they would get secondhand goods, right? So I think we need a few great companies to do what you just described, and then maybe that will actually create an alternative way to go public, but no one is really pitching that to it. Like none of the bankers are saying, "Hey, okay, you guys, we're going to take this company, which is at $200 million in revenue. We're going to take it public there, and then we'll 2 years from now we'll be on NASDAQ." And to be candid, I don't know how we would sort of react to that, because the question is, okay, what sort of multiple are we going to get, right? Because over there, the multiples tend to be more compressed.
Yeah.
So, and the thing is, for a great company, like your ability to stay private and raise more capital at higher valuations is there, right? It's just, I mean, it's a fact of life. Like, just increase your ARR, get a good multiple. Someone will fund you at like, okay, you raised at 1.5 billion. Let's just raise at 3 billion. Let's just raise at 5 billion. And so, because the private markets at the growth sort of growth sectors are really sort of easy, not easy, but easier to raise from, then you stay private for a long, long time.
Yeah, eventually, like we said before, there's just more money in the public markets. And I think somehow someone's going to have to figure this out. Maybe it'll be the Clavier-Eisenberg Alliance for secondary markets, for markets in other countries. List there first. Hey, so you have something called the 3 asses rule.
Yes.
You want to tell everyone about that?
I mean, I haven't sort of used the 3 asses for a while. It's basically, so people once asked me what I was looking for, and I said, look, it's basically a smart-ass team building a kick-ass product in a big-ass market. Those are the 3 asses rule. And we used to have like a fun interpretation of that. I think we still kind of use that, but we focus more on, hey, let's just zoom in on the team, so the smartest part, and make sure that we operate in the biggest market. And then the kick-ass product is something that we'll care about, but because we're doing more pre-seed these days, we really sort of angle on the team.
Well, what is a smart-ass team?
It's the right combo of people who have enough experience of the sector that they're trying to work in, or the tools that they're trying to build, so they can really understand their target sort of user and the functionality that need to be built, but are not so locked into it that they would not innovate and reinvent the way things are done. They have, it's the right combo of like an awesome leader, someone who's great at projecting and telling a story, right? Storyteller in the CEO seat, someone who is able to attract both investors and employees. An awesome, CTO, architect, someone who's really able to think about a next generation architecture, infrastructure, product that can scale, and so on and so forth. And, if you add a third, that's probably someone who's really strong on the product side.
So you've been at this a long time, and I like to ask this question of people who've been at this a while. So that's what you're looking for. Do you have a methodology for knowing whether you found it, or is it all in your gut?
I mean, the methodology would be, hey, we just check what they've done. We talk to references. We, try and get a view from people in our network who know them. So very often we're gonna, fish in very dense ponds, like people who work at Meta, or people who work at Stripe, or like really like strong schools, right? But sometimes recently we bagged the first engineer at Instagram. Shane is incredible. So like, based on their pedigree and resume, we're gonna sort of know that they probably have something interesting. But at the end of the day, we spend roughly between a week and 2 weeks to run our process, and it's kind of gut feel, confirmed by tools and references and talking to people. But like, at the end of the day, when you meet someone and that they have it, and you look at the team they've assembled and you're super impressed. I had the case recently with a company called Koobz, Koobz, which is additive manufacturing for the shoe industry. And the founder is incredible. He spent 2 years figuring out the process that the company was going to use to print shoes at scale. And he assembled a team of execs that joined him at pre-seed when he had almost raised no money, because his vision is so great and he is so great that he convinced those people to leave their jobs or their retirement to actually join him. And when I saw that, I was like, holy fuck, this is one of the strongest like exec team I've ever seen in a pre-seed stage company. And so talking to him, spending time with them, I knew. And every bit of information that I gathered through my reference calls afterwards were just confirming that, gut feel that I had.
Was 2005 Jeff able to do that?
2005, Jeff was a dumb fuck who knew nothing. And so I'm really sort of like, one of the things that you need to be a successful investor is being there at the right time and be lucky. And I was there at the right time when, like, often people ask me, hey, how would you go about starting Uncork in this market if you had to start now? And my honest answer is like, I have no idea what I would do, because by definition, what I saw in the market 21 years ago was a complete void between angels on one side, the ones you mentioned, the greats, right? And the VCs. And because of the capital efficiency that Web 2.0 startups had, because suddenly the cost of innovation dropped massively, they just needed to raise like, 250K, 500K, like maybe $1 million, like $1 million round back in the day was massive, right? But they still need a lot of help. And so that was the idea. That's why they called us the super angels at the time, because I was writing my small checks, but doing nothing than supporting founders like full time and putting them together. So I was there at the right time, but yeah, what I got the privilege to do for the past 20 years was because I was there super early. I don't know what I would do if I had to start in this kind of crazy market right now.
Yeah, I don't know what I would do either. You said kind of before in other forums that you had great regrets passing on LinkedIn and Uber.
Yep.
Right? And those are, at least LinkedIn's about 20 years ago, a little less, and Uber, I guess, is a little more than 10 years ago.
Yep.
At this point. Given what you just said now about your gut and 20-year ago, Jeff, et cetera, did you get it right? Did you get it wrong? In retrospect, we all get these things wrong all the time. But like, what was it about not picking up the founder or not understanding something that you think caused you to pass then?
Trust me, I've replayed that. And, as I have, Airbnb, I have so many, I have one of the best anti-portfolios in the market, sadly. So LinkedIn was 2004. I was there in the early days of social media. I was one of the early VC blogger like you, right? You and I were blogging super early, like 2004, 2005. And the world of social media was kind of smaller. So I got to know Reid Hoffman pretty well, and he kindly offered me a spot in the angel round, or it was a Series A that Sequoia led. And, he said, well, Sequoia doesn't want us to focus on monetization at all. So we're just going to build the network during the Series A, and we raise the Series B, and then we'll start monetizing. And I was like, dude, like, no one's going to invest in a social network for people, in industry if you don't monetize. And so I was like, I just don't think it's going to work. And so I chickened. I declined. And I didn't even decline. I didn't respond to his email. And in my stupid mind, I was like, well, if he asks me a second time, I will probably invest, but maybe I can sort of avoid it. And yeah, here went the LinkedIn sort of investment. And then Uber. So I have a funny story with Uber. So everyone knows that Uber was supposedly conceived during a snowstorm in Paris, during a conference called The Web, right? And Garrett was there, and Travis was there, and I was there. And actually, I actually led that group of people through the Paris subway because Paris was completely stuck. And so we were on the outskirts of Paris. We took a cab. We basically got everyone to the subway, and then I led them to the hotel. And then we met for dinner later at Lenny Kravitz's house in Paris. And that's where they actually sort of talked about sort of starting Uber. So I was there. They actually pitched me in June of 2010. Travis was there. Saka had organized the meeting, and I was really sort of intrigued. But Travis said, "But I'm not going to be the CEO," and Garrett said, "I'm not going to be the CEO." And they had brought that random dude that they found on Twitter to be the general manager of the thing, and I was like, ugh, I like everything except the fact that you guys aren't CEOs. And I basically sort of passed because I asked Travis, "Are you going to take over as CEO?" He said, "No, I won't be CEO of Uber." And it was called Uber Cab at the time, right? And at the end of the summer of 2010, I had like one final shot to invest. And actually I said, hey, there was like 100K available. It's crazy that Uber took the entire summer to raise 1.5 million, right? Crazy when you think about it. And I said, I'll take the last 100K. And they said, well, we'll give it to someone from the industry. So no thanks, but good luck to you. And that's my story with Uber. And to be honest, I can't blame myself. I mean, obviously I would have loved to finally put some shekels into Uber, but I passed on for the right reason, because I didn't see that Ron Graves, who's done incredible for Uber, was the right, sort of general manager / CEO for this company. If I don't believe in the CEO, then I'm not going to invest.
I hope people listening understand how hard this business is. You're dealing with like incredible uncertainty, people who are extreme personalities in some cases. The signals that are early, it took Uber a whole summer to raise $1.5 million. Some guy with a PhD in data science is getting $1.5 million a month right now. And it became Uber, and it was really not obvious. And I sat through the Uber pitch when I was at Benchmark, and Benchmark invested. Even then, it was interesting. It was cool. It was growing quickly. It still wasn't obvious. They only had San Francisco. You didn't know if they were going to be able to launch New York. The TLC in New York's a little tougher than the TLC in San Francisco. But, and some of them work out. This is a hard business where everybody's got a big anti-portfolio because it's really, really unpredictable. Which makes
people
me
then tell you, but why didn't you invest? It's so obvious. Like, I wish.
Yeah, exactly. In hindsight, everything's obvious. But that also begs the question. This is, I think, something I struggle with also. Is like, how do you know if you're good at this business? Like, you miss an Uber, you miss a Lincoln. I missed my share as well. You hit some, and how do you know if you're good even?
Two things. First, when I started back in 2004, I didn't want to risk other people's money. So I convinced my wife, my first LP, to let me use $250K of our hard-earned savings. We had made a little bit of money at Reuters when we sold our startup. So I started with $250K, saying, okay, if it works, we'll go to $500K. So that was my fund. And I started making, 25, 50K investments here and there. And when it's your money, you really, really pay attention, right? And like what I mentioned, like the key thing for me that unlocked like the now Jeff Clavier and the Uncork story is the fact that some of my early bets in the Web 2.0 space got acquired super fast. Like my first investment, Truvio, which was a video search engine pre-YouTube, right? We funded in January of 2005. And in December of 2005, there's a bidding war between Fox Interactive and AOL, and we sell the company to AOL for 17x our investment.
By the way, my first exit was to AOL as well. Also a quick acquisition.
Awesome.
There you go.
God bless John Miller. I sold him a bunch of things afterwards. We became good friends. And so that one, and then a few others, like literally, I had returned my own sort of fund 5 times by the time, like within 3 years. And so I wouldn't claim that I was good, but at least I didn't bankrupt the family, which was obviously my number one. And we had 2 young kids. My wife couldn't actually work until we got a green card, so I was the sole bread maker. And so starting Uncork when I did was absolutely insane. I should have kept my cushy, VC job and just, gotten my salary, because like when you invest your own capital, you don't have income, right? So it was insane. What I did was stupid crazy. It just worked, right? I think the imposter syndrome kind of left me in 2008 when I had my first IPO, because as you know too well, the day you actually put like a company on the board, on like you go to New York and you go to the ceremony at the NYSE or NASDAQ or whatever, then you're in the other band, right? The one that had IPOs. And then you start counting the number of like stars that you have on the number of IPOs. Not saying that that made me good, but I felt that that brought some legitimacy to what I was doing. And then I would say now when I look back, so, $1.2 billion management, 285 sort of companies, bunch of exits, a bunch of IPOs, and the team that I've assembled is exceptional. And I'm grateful for that. And I think somehow I kind of didn't suck too much.
By the way, what was the first IPO in 08?
Fitbit in 2008.
Begs the question. So you just celebrated the 21st anniversary of Uncorked, and you also, I think, announced that you're stepping back from day-to-day management of the firm. And I'd like to understand, first of all, what that means. But the other question that I myself struggle with, and one needs to struggle with, is, when are you too old for the business? Like, you finally convinced yourself that you're good at the business, or you can do this, or you don't suck at it, to use your term. And then, because these things take so long, these companies take such a long time, you find yourself in year 21, say, I'll take a step back, and maybe I'm on the other side. How do you think about that?
I think that as long as you're working hard, you're getting, great deal referrals from the ecosystem, and you're still able to make a difference for entrepreneurs, and your advice is on point and like well-timed, as opposed to like, this is the advice that would have given you like 15 years ago, I think you can do this until whenever, right? To me, it's more a question of, hey, I'm 57, right? I'm actually not 58, but I was 57 when I made the decision. And my wife retired 3 years ago from Stanford. And we have a 1-year-old grandchild. What do we want to do as a family? And I've been working my ass off for 21 years, like nights, weekends, travel, and so on and so forth. And I've said, look, I've enjoyed this. This is my life's mission. I'm grateful for what I've done, but I also want to get a bit more sort of me time. And I'm lucky to have my partner, Andy, who's an incredible sort of leader, who, like me, founded a startup and then got into venture. And I kind of groomed him, and he demonstrated, because he hired the bulk of the team that we have, that he was an extremely gifted sort of picker on talent. And so I said, look, you started to make him sort of co-managing partner a few years ago. So we run the firm together. And as we raised our new funds, I said, look, it's time for you to run this thing. And so I'll step back. You will be the sole managing partner. So now I'm just a regular partner. And I will continue doing this for another 3 years. I'm super active. Like I've already done 2 deals in the new funds, and I'm working on our third. And this is awesome, because like the day-to-day management is something which I've now relegated to Andy. So not that I have more time and I still don't do everything which I want to kind of slow down on, like travel and going out and everything, but I'm doing it on my terms. And we'll see in 3 years whether actually step back and stop being a GP. That's my intent. But maybe at the time I'll say, oh, fuck it, I'm just going to do it another fund. But at least the firm is in great hands. And the pandemic really sort of triggered this for me. Like, I was the key man. I was, the sole signatory, and I was the only one who could approve um, like wires and stuff like that, right? And suddenly I was like, well, if I have COVID and I get under a ventilator, nothing happens. And so I had our lawyers draft a business will, which said that, and it was awkward, right? My wife and my assistant could deem me incapacitated and could pass the responsibility of signatures to the new COO of Uncork, Andy. That was awkward, dude. But that really sort of that sparked this notion that, hey, we can never be in a situation where the firm depends on me sort of being there. And so we rewired everything so Andy could actually be the other guy who could sort of make this run. And I was like, well, shit happens. Unfortunately, I just learned yesterday that one of my friends just died in his sleep. He was like in his 50s. It's a disaster, but this happens. And so you need to have a mentality where, like, the firm can't depend just on you to be there. And, the show must go on. And so that sort of triggered this, like, deep thoughts about how I wanted to make this happen. But also what I was doing, I was like, well, it's not a backup. It's going to be the front man.
Are you going to keep investing even if you leave the firm in 3 years?
I think so.
Yeah.
I think, I mean, I don't know. Look, I can tell you that I've acquired a vineyard in Walla Walla, Washington. I'm starting winery, which is sort of a new startup.
Wait a minute. The Frenchman has acquired a vineyard in Washington to make wine. I just want to make sure I have the picture clear.
Yes.
Bordeaux wasn't good anymore? Climate change?
I don't want that. Bordeaux has, plenty of great sort of owners and winemakers, and I think they have their own issues with, and I don't want to go back to France anyway. So my wife and I have decided to move to Washington. So we're leaving California, right? In six to 9 months, we'll be up there in Walla Walla, Washington. We have bought a vineyard. We're making wine as we speak. We just got our Merlot and our Viognier picked up, and the rest of the fruits will be picked up in the next month, and we'll make, sort of 3 wines this year to get started. Small production, 350 cases on list only, so no retail presence, no one tasting room, whatever. Super chill, and that's going to be a fun project for me to spend time on. As to whether I will keep my board seats. I will continue working with my companies. I may, sort of mentor a few VCs because this is something which I love doing, and there aren't that many sort of great mentors or coaches for VCs. I may do that, but investing, I don't know. Probably not.
What's your personal core values?
My dear friend and mentor, Brad Feld, taught me about the fuck me once rule, which basically says, I will trust you and I will work with you and I will, back you, but fuck me once and we're done, right? So I have this sort of deep sense of, like, I support people, I help people, but if they fuck with me, then we're done. And I tend, like, my team will tell you that I don't care about people, which is true and not true. I care deeply about a small group of things, and then I don't give two shits about most, what they think, what they say. So very much like I've been there. I've got to where we are through hard work, dedication, and supporting, entrepreneurs. And those are the core values that we have, I think, at Uncork, where we're really there. Like, I was getting interviewed, and someone was asking, like, what's the key difference between you and other investors? And I'm like, well, when there is a big messy problem that happens in a startup, we literally run towards it and we try and fix it as soon as possible. Whereas, a lot of investors will kind of step back and see whether the thing, gets treated, managed, handled without them getting their hands dirty. We really very much, like, run towards those kinds of challenges. So it's what we do and how we do it, which is basically the core values that I've developed over the past 20 years. And I make sure that, as I step back, it's really ingrained in the firm.
What's motivated you personally to kind of get at this hard for 21 years and then now to step back?
It was a startup, and so by definition, it was kind of weird. I was like, okay, there is an opportunity in the VC world which hasn't sort of seen a new, because we basically invented a new stage, right? You had Angel, you had Series A's, and you had nothing in like before, right? And we just inserted ourselves and we created an industry which is, managing billions of dollars and that's created trillions of dollars of value. And so I thought it was kind of interesting. I don't like my dear friend Josh Koppelman, I think has had a real vision that this could become what it has become. I was more like, hey, this sounds like a good opportunity. Let's have at it and we'll see. And like in 2007, I kind of didn't raise a fund because I wanted to. I raised the fund because I could. Because people came to me and said, hey, you're good at this. This is working. You have all those exits and outcomes in companies and whatever. And you're basically getting in all the rounds you want. Like, won't you go PM other people's money? And I was like, well, I don't want to spend 2 years in misery to try and raise a fund. So if I could raise a fund quickly, I may do it. And because I didn't need to, it kind of became a thing, which is kind of weird. It's really super bizarre, where literally I raised 15 million in 8 weeks, right? Which
Amazing.
never happens.
Yeah.
Right? So I got very lucky to kind of talk to the right people and at the right time in the industry and so on and so forth. And then once that worked, then I was a fiduciary. I was, responsible for this money that LPs sort of gave me to invest. And I worked super hard to do everything as a solo GP. And I was a solo GP for 6 years. I probably slept, 3 to 4 hours a night during that time. Probably cut off, a few years of my life because of that. And in 2010, I was like, okay, we're gonna raise the next fund, and I'm not doing this on my own anymore. And that's when I decided to actually build a firm and bring a team together to support me. And I'm way, way happier now than I was then, because, I had to do everything, every single thing I was responsible for. And now I'm actually sort of comfortable stepping back and letting my sort of baby go, because it's grown up, the firm is an adult, and it's in incredible hands. It's a bit like, when your kids grow up and they leave the nest and you're supporting them and happy to see them, but they have to go.
So I feel like, by the way, this is just, I think, an incredible conversation around the evolution of the firm. If you were starting again today and you were 28, 9, 30, what's the current institutional seed thing? Like, where's the seam in the market today that you would go for if you were starting again?
So I think that what I would do is try and find like a niche where I am incredibly kind of well suited to pursue like the entrepreneurs and the ideas, and I can add a ton of sort of value add, and I would sort of go from there. So like today, Uncork is investing in everything. We do consumer marketplaces, AI first services on the vertical side, AI tooling. I have a stealthy investment in an LLM. I do nothing but deep tech, and so there's nothing that we don't do, except we don't do much healthcare. We don't do much, but like we look at everything, right? So we're like the definition of a super broad investor. And we can compete because we're Uncork, and that's, we've had great outcomes in all categories. If I was starting today, I would really focus my energy on, okay, this is the one thing I do, and I'm going to try and get the best opportunities in that sector and then grow from there. And I would try and be like quite narrow, but really, really good, and build the reputation of awesome entrepreneur support, great deal flow, and then, take it to the next level and then start branching out.
We lose a lot of money in seed investing, right? You lose a lot of companies. The ratios. I asked Brad Feld, you called him your mentor, what to ask you. He said, how do you decide and when do you decide to say goodbye to the entrepreneur and it's not going to work out?
So that's really, really hard. We should probably say goodbye earlier than we do. Brad always told me, hey, I always write one check too many, right? So I should probably, like, when things go bad, I look back and I say, the last check, I should probably not have written it. At the same time, there are sort of companies which sort of make it after going through like really hard times. Like, none of my multi-billion dollar exits made in a straight line. They all died almost, 1, 2, 3 times, 7 times for Fitbit. And they still made it, right? And so if you're not there, I saved Postmates ass, a couple of times by being sort of the provider of last resort. Like, I fronted their payroll, just before they closed the Series A. I led a second seed because the thing was barely launched and wasn't working. So you have to have conviction and be supportive, but you can't be blind either. And so at the end of the day, if you've given it your all as an investor and you sort of, as the entrepreneur, hey, are you sure this, like, you want to keep on going? And it's the case. We have those conversations with people now when, like, 10 year, 15 years, 12 years into it, the company is like a 10, 15, $20 million ARR, clearly never delivered on the promise of growing, big and fast. What do you want to do? And if the entrepreneur says, look, it's just too hard and I've tried everything and I think I'm going to let it go, then we're like, okay, fine, let's just sell the business. And because for us, it's cash. For you, it's opportunity cost, right? It's your time, right? And so you have to have real conversation. And that's why we want to build those real kind of trust and relationships with our founders so we can have those very hard conversations. Those are the same when you have, a founder who's, gotten the company to a certain level and then Peter's principle, they just can't scale and you have to replace them. And that, unfortunately, those are tough times, but they happen.
I think people don't appreciate just how much you packed into that one answer. Like, you funded Postmates payroll, even though it didn't have much to show for it. You did a double seed in Postmates, even though it didn't have much to show for it. At the same time, a guy who's gotten to $10, $20 million, and there aren't a lot of companies out there you get to $10, $20 million of revenue. Is just a dud, is not going anywhere, and you have to have a hard conversation. It's really the artist business. I need to ask you one last question as we're getting to the hour mark here. How did you get the @Jeff handle on Twitter? How come I can't get Michael?
So I was early on Twitter, clearly, right? But I wasn't Jeff at the beginning. I was Jeff Clavier. And I noticed that Jeff was taken by someone who hadn't tweeted for, like, I think he had tweeted like once. And so I reached out to Ev or Goldman. I don't remember who I sort of pitched, but I said, hey, like, give me Jeff and I will tweet and I will, do my thing or whatever. So there will be good for you. And I think I was one. They sort of figured out the transfer of handles through that process, and I was probably one of the first handles transfer.
Has anyone tried to buy it from you?
Oh, fuck that! Hey, it's not. It's forbidden. It's against the TOS. But no, I mean, it's fun to have a Jeff because people don't believe that I have a Jeff, and I'm like, well, I'm a Jeff. But then what I realized,
you have great wine sales from @Jeff.
Yeah, that people think that Jeff space Bezos is Jeff Bezos without the space, and so I get a lot of mad, support requests or whatever, from so. Like having and I got, my wife got Bernadette as well, so we are Jeff. So we're one of a very very few first name handles couple.
Wow.
Right. And yeah, when I got at Jeff, people were like, "How the fuck did you pull it off?" And a lot of my friends, essentially, like my friend Rodrigo, got Rodrigo through the same process. So yeah, that's be early and hustle, with the founders. Funny story, we talked about LinkedIn. At some point in 2005 or something like that, yeah, Reed asked me to actually stop being so aggressive at inviting people to join LinkedIn because I was spamming everyone, and I was in the race to, I don't remember if we, like, the first person to have 25 or 50 connections on LinkedIn. So I was super early on LinkedIn too.
Amazing. Jeff, thank you for doing this. I really appreciate you taking the time early in the morning. This is an incredible conversation. And what I want people to actually take away from it is, number one, hustle counts for a lot. Number two, this is a hard business. And being at it for 21 years, knowing what you're doing and building a firm that lasts is actually super unusual in the business. And take anything you can from Jeff, any mentorship you can. I've enjoyed the relationship over many years, decades at this point. So thank you for everything you do for the ecosystem, your investments, and really being the pioneer of the seed category. Thanks for joining us.
Thank you, Michael. I would love this conversation, and thank you for doing this. This is a labor of love, and doing building a firm is hard, but doing a great podcast is hard too. So thank you.
Thanks, Jeff. If you enjoyed this podcast, please rate us 5 stars on Spotify and Apple Podcasts, and subscribe to the YouTube channel because you want to hear more of Jeff's content and more of invested content.